Hello and welcome to Financial Accounting with Anne-Marie Anderson. Today we're going to be learning about depreciation. As always, let's start with the definition. Depreciation is the systematic allocation of the cost of a tangible long-term asset over its useful life. It represents how much of the asset's value has been used up over time as it helps generate revenue. A couple of key points to remember. Depreciation only applies to tangible long-term assets, and these assets must be used in the business. They can't simply be held for investments. Oh, and land, though a long-term asset, is never depreciated. Let's see an example of depreciation in action. Our business buys a new delivery truck, which costs $50,000. We are expected to use it for the next 5 years. This is called the useful life, and the residual value is estimated to be $0. This means we don't expect it to have any value when we're done using it. The journal entry would be a debit to the asset, truck, and a credit to cash or payable if you still owe money on it. Great, so now we have the shiny new truck, but we're out $50,000. Well, in accounting, we treat that $50,000 as if we were spreading the cost over all the years we plan to use the asset in our business. That means $10,000 of expense each year. Here we are at the end of 5 years, and our truck is a little worse for the wear and ready to be retired. The current value in our accounting records, or the net book value, is $0. Hold on a second. How did we get from $50,000 to $0? Well, let's get into the mechanics of that. Okay, remember 5 years ago when we bought the truck and recorded it as a $50,000 asset? Good. So now let's take a look at year one's depreciation of $10,000. This journal entry is performed at least at the end of every year, and regardless of depreciation method we use or what we are depreciating, the journal entry stays the same. Debit depreciation expense and credit accumulated depreciation. Let's take a closer look at the accumulated depreciation piece. Here we have the T accounts for truck and for accumulated depreciation truck. Accumulated depreciation truck is a contra asset account. It means it carries the opposite balance, a credit balance, and the two accounts are presented together as a net number. So if the truck is worth $50,000 and the entry we just made had a credit to accumulated depreciation of $10,000, the net book value of the truck in our records is $40,000 at the end of year one. We've recorded year one. Let's move on to year two's depreciation. We record the same journal entry at year end, and now we have $20,000 in accumulated depreciation. So the net book value in our records is $30,000. Fast forward a few years and we capture years 3, 4, and 5, and now our accumulated depreciation account has $50,000, and that makes the net book value of our asset $0. So now let's take a look at the other side of that depreciation entry, depreciation expense. We record that $10,000 expense each year because we are spreading the initial $50,000 cost of the asset over the 5 years of useful life. We are required to capture this expense per the matching principle. The cost of a long-term asset is allocated and expensed over the periods in which it helps generate revenue. This means that each year the truck generated revenue for us as it delivered its packages, and we record the $10,000 cost of its depreciation expense per the matching principle. Let's rewind a little bit. There's one item that I mentioned earlier that needs a bit more explanation: residual value. Residual value can be called several different names, including trade-in value, scrap value, or salvage value. They all mean the same thing: the estimated worth of a fixed asset at the end of its useful life. In our earlier example, we said that our truck didn't have a residual value, but if we changed our mind about that, then we would just adjust our depreciation calculation accordingly. Speaking of depreciation calculations, there are many ways you can depreciate assets, but some of the most common methods are straight line, double declining balance, and units of production. See the videos on those for more calculations. Capturing depreciation is important because it reflects the gradual loss of an asset's value over time, ensuring accurate financial statements and matching expenses with revenues. Thank you for watching. If you want to learn more about accounting, please see additional videos on my channel.